Good evening, everyone. First and foremost, I am thankful to Taxmann for organizing the webinar on such an important topic, which I am sure all the exporters or the consultants who are advising the exporters would be keen to understand the issues that we are going to discuss, the possible solutions, and what, in my mind, the government should consider to ease out certain burning issues. So without wasting much time, let me just share my screen. So as the topic indicates, what we are going to discuss are the burning issues which currently the exporters are facing in claiming the refunds of GST. The issues are arising on multiple accounts. The issues are arising because the exporters are also simultaneously availing certain benefits which are available under the foreign trade policy. And because of the interplay between the foreign trade policy and the GST provisions, there is a gap, there is a lacuna, and that is what is resulting in the issues which we are going to discuss. Then there are certain benefits which are granted in the GST law itself, which has implications on the claim of refunds. So this is a second broad area where the issues are arising. And then there are certain circulars which have been issued by the board, which are, as we will discuss, contrary to the provisions of the law. And therefore, there is again a friction between a circular and the law, and this is a third basket of the issues that we are going to discuss in today's webinar. So without wasting much time, let me just, I'm sure all the participants are aware the kind of issues we are going to discuss. It is already part of the announcement which has been shared on the website of Taxmann. So let us first understand the basics. So let me spend maybe 10 odd minutes to help you understand the basics of the law which we are going to discuss, so as to better appreciate the issues and the possible solutions for those particular issues. So since we discussed that the major reasons why issues are arising is because of the interplay of the foreign trade policy with the GST provisions, hence it is important to first have a basic overview of the foreign trade policy and how it basically coincides with the GST law. So foreign trade policy is formulated by the government. The power to formulate the policy stems from the Foreign Trade Act. Section 5 of this particular act grants the power to the central government to formulate the policy. This is this exercise of power. The foreign trade policy for 2015 to 2020 was formulated. It was extended till 31st March 23. And now we have the new foreign trade policy 2023, which is come into effect from 1st April of this particular year. Now, what are the key schemes under the foreign trade policy where certain benefits of GST are also intertwined? So when you look at broadly, chapter 4, 5, 6, and 7 of the foreign trade policy, will find certain schemes where certain exemptions, remissions, or rebates are available. So when we talk about exemptions, the principal scheme which a lot of exporters are basically availing the benefit is the scheme of advance authorization, where under the policy, an exporter can apply for a license. This is the license. The exporter is permitted to procure certain inputs without payment of duties, which includes at times custom duty as well as IGST. And this is that license, the exporter is given an obligation to make certain exports. If the exporter fulfills the obligations, then the benefits that the exporter has availed under the scheme by way of exemptions are stand to be unequivocally available. Then there is also a duty remission scheme, which is known as duty drawback, where on exports, a drawback scheme has been formulated basis which a drawback of the cost in terms of custom duty, which is embedded in the price of the goods which are exported, is ultimately remitted back by the government. The drawback rates are fixed by the government, basis which this amount is credited to your accounts. Then there is a special scheme for textiles, which is a scheme for rebate of state and central taxes. Then there is a ROTAP, which is again a scheme available generally to large set of export products, where there are certain domestic duties and taxes which form part of the cost because they are not creditable. it is to offset that cost. The scheme has been formulated, basis which a certain amount of your export value is given back by way of remission in terms of ROTAP scripts, which are ultimately encashable or even usable for making payments of certain duties at the time of your imports. Then there is an EPCG scheme for capital goods, where you can procure capital goods without payment of duties, including GST. And again, export obligations are casted on such exporters who avail such benefits. Then we have special schemes for EOUs, for EHTPs, for STPs and BTPs. These schemes are largely not right now much in vogue, but still there are existing EOU units which are facing issues related to refunds, and therefore this also becomes relevant for our discussion. Then there are deemed export schemes whereby a person may not be directly exporting his goods. The person may be giving it to another person who may be a manufacturer or a merchant exporter, and it is eventually that particular person who makes the final exports. However, under the foreign trade policy, certain benefits are available to such transactions where exports are not done directly, but exports are done indirectly, and the realization may also happen in Indian currency. Realization of the proceeds may not happen in foreign currency. So these are largely the schemes under the foreign trade policy where a person who is undertaking the exports can avail of the benefit. Now, how these schemes are operationalized? The foreign trade policy, as we discussed, is formulated under the Foreign Trade Regulatory Act. The foreign trade policy is a document which states the basic framework as to how the benefits under the particular schemes can be availed of. However, since you are aware, actual imports and exports are governed by the Customs Act. So eventually the notifications are issued under the Customs Act to effectively implement the schemes which we have just discussed. So in the context of Customs Act, you will find series of notifications which have been issued and which are amended from time to time. The context of EPCG, you will find that the notification 16 by 2015 grants the benefits by way of exemptions from duties of customs as well as IGST on the import of capital goods which are covered under the scheme. Then for advance authorization, we have multiple notifications because we have different types of advance authorization. So we have notification 18 by 2015, 20 by 2015, 22 by 2015, and 45 by 2016. So these are 4 notifications under which a person can procure inputs without payment of custom duties, without payment of IGST, and basis which the person has to fulfill the obligations given under the particular license issued to such person, basis which the benefits of this scheme can be availed of. In the context of EOU, STP, EHTP, there is notification 52 by 2003. All these notifications are amended from time to time, basis which the exemptions are available in terms of duties of customs as well as GST. Now, there is another act which also an exporter needs to be aware of, and that is the Foreign Exchange Management Act, because Customs Act deals with the aspect of exports and imports in terms of actual transaction. Foreign Exchange Management Act deals with the realization of the exports that have happened or the payments against the imports that have happened. So under the Foreign Exchange Management Act, RBI is given the authority to frame regulations dealing with exports and imports, how the settlement of those transactions would happen. So principally, we will be concerning ourselves with these 2 notifications which have been issued. That is notification 381, which deals with import transactions, and notification 381E, again, which deals with export transactions, whereby the Foreign Exchange Management export of goods and service regulations have been notified. Then we have master directions issued by RBI for exports. We will deal with Master Direction 16, which governs the regulatory aspect as regards the realization of export proceeds in respect of goods as well as services. And therein there is Master Direction 17, which deals with regulatory aspects dealing with payments made against imports of goods and services. Apart from what we discussed, we also have another set of regulations which again deals with exports, whereby we have the SEZ scheme. This is a scheme introduced by a special act by the Parliament, unlike the other schemes that we saw earlier, which are formulated under the Foreign Trade Regulatory Act, which is already also been passed by the Parliament. So this is a separate uh, 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 mechanism formulated by the Parliament to incentivize exports from our country. So basis which SEZ Act has been formulated, basis which a person can physically set up the SEZ as a developer. Units can then be ultimately operationalized in the given SEZs, and then those SEZs can also avail of host of benefits which are available under this particular law. We have SEZ rules also formulated pursuant to the powers available under the Act, which deals with all the procedural aspects related to SEZ developer and SEZ units. Then we come to GST. So we have seen the foreign trade policy. We have seen the provisions related to foreign exchange management. Then we have seen provisions related to SEZ. Now we are actually seeing the provisions related to GST, which is the topic for the day. Now, when you look at the GST Act, as you are aware, there are two set of acts that we are going to concern ourselves with. It is the IGST Act and the CGST Act. As GST Act, for the purpose of our discussion, has similar provisions as related to CGST Act, and therefore whatever we discuss in the context of CGST Act equally applies also in the context of the respective SGST Acts. Now, let me take you through the key provisions under the GST law for you to better appreciate what we are going to discuss henceforth. So this is an extract of the relevant provisions that we are going to just discuss to just help you understand the issues. If you see the way the exports have been defined under the GST Act, this is an extract of the IGST Act, where clause 5 of section 2 of this act defines the export of goods to be taking goods out of India to a place outside India. So at this point in time, please pay attention to this fact that the definition of export of goods under the IGST Act does not contemplate the realization of the export proceeds for the transaction to qualify as exports. What is to be satisfied is the aspect of taking the goods out of India to a place outside India. If a transaction in question satisfies this particular aspect, then that transaction would be considered as an export of goods. Export of services is defined by clause 6. Export of services definition is slightly broader with more conditions as compared to the definition of export of goods. The export of services requires that the supplier should be in India. The recipient of your service should be outside India. The place of supply of the service should also be outside India. So not just the recipient should be located outside India. Even the place of supply of your services should fall outside India. So for purpose of determination of place of supply, we have section 12 and 13. In this particular context, if the recipient is outside India, section 13 of the IGST Act would become relevant. And therefore, the said section 13 has series of rules by which one can determine the place of supply basis the nature of services is concerned. The default rule suggests that the place of supply is always the location of the recipient, but then we have exceptions to the general rule where, as an illustration, in the case of intermediary services, the law says that the place of supply will be the location of the supplier and not the location of the recipient. Similarly, we have place of supply as a location of property where the services are directly in relation to an immovable property. So similarly, we have other exceptions in section 13 basis which the place of supply is to be determined. If basis that determination, if one finds that the place of supply is actually outside India, then one can say that the third condition of the definition of export of services also stands satisfied. There is a fourth condition also attached to the definition of export of services, unlike the definition of export of goods, which is saying that the payment for such services should have also been received by the supplier of service, either in convertible foreign exchange or even in Indian rupees, whenever RBI permits the realization in such manner. And there is a fifth condition also attached to this definition, which says that the supplier and the recipient should not be establishments of a distinct person. In other words, supplier and recipient should be separate legal entities. They should not be mere establishments of a same legal entity of the same distinct person. So a transaction can qualify as an export of service only if all these five conditions are satisfied. If one of the condition is not satisfied, then the transaction would not qualify as an export of services. Import of goods is defined in clause 10 in a similar way in which the export of goods was defined to say that it is an act of bringing the goods into India from a place outside India. Import of services is defined under clause 11, whereby similar to what we find in the definition of export of services, we have three conditions. Supplier should be outside India, recipient should be in India, and the place of supply also should be in India. So if the place of supply is not in India, then in that situation, the transaction would not qualify as an export of services, as an import of services, and therefore in that situation, that transaction would not form part of scope of supply under section 7, because as you might be aware, under section 7, only import of services have been deemed as part of the scope of supply. So only if a transaction satisfies these three conditions, then only one can say that it comes within the ambit of the GST law, and basis which there is a liability to pay tax under reverse charge mechanism in certain situations. So this is background of section 2. Apart from section 2, we also need to understand section 16. Now, section 16 of the IGST Act actually grants the benefit of zero rating. Now, section 16 is bifurcated into 4 subsections. This is the law that we are discussing as on date. That is the amendment which has become applicable from 1st October 2023. Now, what section 16 basically says? Section 16 subsection 1 defines the zero rated supply to mean two kinds of supply. One is export of goods or services. We already saw the definition of export of goods or services. It also includes the transaction where directly the goods are not exported, but the goods are ultimately supplied to an SEZ developer or SEZ unit for their authorized operations. So this is also considered to be part of zero rated supply. Once a transaction qualifies as zero rated supply, then subsection 2 says that only subject to 17.5, a person would be entitled to avail of the credit in respect of the inward supplies which are used for making the zero rated supplies, even if such zero rated supply is an exempt supply. So in a way, the benefit of zero rating is that whatever tax that you have paid on your inward supplies which have been used in making the zero rated supplies, the credit of all those taxes would be available, even if what you supply is not liable to GST. The only restriction here is 17.5. So under section 17.5 of the CGST Act, there are provisions which restrict credit in case of certain inward supplies. So even if let us say that particular inward supply which is covered by 17.5 is used for making zero rated supplies, then in that situation, the credit would still be restricted. The credit of that tax, what you have paid on that particular inward supply, would not be available. Barring 17.5, no other restrictions under section 17 would be applicable. Thereby, in a way, all the taxes that you have paid on your inward supplies which are used for making the zero rated supplies, the credit of all of those taxes would be available without any other barrier or without any other restrictions. Then we have subsection 3 and 4. These are amended provisions. Basically, subsection 3 says that all the registered persons who are making such zero rated supply would be eligible to claim the refund of the unutilized credit that remains on account of zero rated supply. However, this particular subsection says that by default, such registered persons must make such supplies without payment of IGST under bond or LUT, that is letter of undertaking. Then it makes an exception where it says that under subsection 4 that the government has been given the power to make a recommendation as to which class of person should be eligible to make zero rated supply on payment of integrated tax and claim the refund of that tax, or the class of goods or services where exports on payment of taxes would be permissible. So basis which government has issued notification whereby barring certain restricted products, government has permitted all the exporters to make exports or to make zero rated supplies on payment of integrated tax and claim the refund of tax. Proviso to subsection 3 is also very important, which also we will touch upon when we go to the issues. The proviso to subsection 3 says that when a person is making a zero rated supply, and if the person is not able to realize the sale proceeds, then the proviso says that the person will have to deposit the refund, whatever earlier he has claimed under this particular subsection, along with interest within 30 days from the time limit within which, under the Foreign Exchange Management Act, a person was supposed to receive the foreign exchange remittance, and thereby this is where again a restriction in a way has been brought in place to say that even if you have claimed the refund by making zero rated supply under LUT, eventually if you are not able to realize the foreign exchange within the permissible time under the Foreign Exchange Management Act, that situation the proviso says that you will have to pay back the refund which you have received earlier with interest in the manner which would be prescribed. We will also see the relevant rule as to how this particular mechanism is sought to be made applicable. So this is a provision which has now become applicable. Prior to 1st October 2023, the provisions were structured in a different way. There was no subsection 4, there was only subsection 3 to section 16, which says that a person, a registered person who is making the zero rated supply is given an option to claim the refund of unutilized credit either by making the zero rated supply without payment of IGST under LUT, or by making the zero rated supply on payment of IGST and claiming the refund of that tax. Now, to operationalize the refund claims which are arising on account of section 16(3) and 4, which we just saw, CGST Act also has made certain provisions permitting the refunds in certain cases. So section 54 of the CGST Act deals with refund provisions. If you see section 54(3), it says that in case of an unutilized ITC refund, a registered person is allowed to claim the refund only in two situations. First, by under subclause 1 is where a person is making zero rated supply without payment of tax, and then there is subclause 2, which says that where the credit has accumulated on account of inverted rate structure. So these are the two situations where the law says that the refund of unutilized credit will be available. So when you harmoniously read section 54(3) with 16(3) and 4, what it appears is that when a person makes zero rated supply under LUT, the refund claim would then be filed taking recourse to 54 subsection 3, and basis which a person would be eligible to claim the refund. If a person makes the zero rated supply with payment of IGST, that is under subsection 4 of 16, then in that situation the refund would be filed ordinary, the shipping bill itself is considered as a refund application, and basis which the refund would be filed, that is the refund which the claim which arises under section 54 subsection 1. So these are broadly the provisions of the Act. Then we have also the limitations within which a person is supposed to claim the refunds under both the situations, that is either under LUT or under the with payment route. So that limitation which is under subsection 1 of section 54 is 2 years from the relevant date. The relevant date has been defined under section 54 explanation, which in the context of exports would be the date when the ship carrying the goods physically leaves the customs frontier. In case of services, it would be the date on which you realize the foreign exchange, or the date on which you issue an invoice, whichever is earlier. So if you are realizing foreign exchange in advance, the 2-year limitation would start from that date. In a case where you have issued an invoice and you are going to realize the foreign exchange late, then it is the date of realization of foreign exchange that would be the relevant date, and it is 2 years hence that within which you can claim the refund. This coincides with what we saw earlier, the definition of export of services, where one of the condition out of 5 conditions is that a person should realize the consideration against the export of services in either convertible foreign exchange or in Indian rupees, wherever the RBI permits. So it is in that context that the relevant date has been structured in this particular manner. In case of deemed exports, the relevant date would be the date on which the return indicating the supply in question is furnished. So this is broadly the law. Then we have section 147 of the CGST Act, which grants power to the government to notify certain supplies as deemed exports. These are the goods which are manufactured in India. So basis which government has issued notification 48 by 2017, where certain categories of transactions have been notified as deemed exports. Principally, the transactions where the goods are given to an advance authorization holder, the goods are given under EPCG, goods given to and supplied to an EOU unit. These are largely the transactions which are covered within the ambit of deemed exports. Once a transaction is partakes the character of deemed exports, then section 54(1) read with rule 89 permits the refund claim of the tax charged on the given deemed exports either by the supplier of the transaction in question or the recipient of the transaction in question. So this is largely the law that we have when we say the law in a sense, the act passed by the parliament. Also, we have set of rules, notifications and circulars that we will touch upon as and when we touch upon the issues. So this is broad framework that one should keep in mind. As we were discussing, it is rule 89 to 97A of the CGST rules which have the provisions dealing with the manner in which an exporter can make the claim of their refunds. So this is largely the framework that we have. Now let us touch upon the issues that one currently faces. These are all live issues. These are the issues that one needs to properly consider and plan their activities. So the first issue is the restriction which comes under Rule 96, Sub-Rule 10. First, let me take you through that restrictions to better appreciate what I am trying to suggest. Now, Rule 96, as you can see on your screen, is basically a rule dealing with the manner in which the refund of integrated tax, that is IGST, paid on goods or services which are exported out of India would be processed. If you see their sub-rule, starting from sub-rule 1, you will find that this set of rule is basically procedural in nature, where it talks about what would be considered as an application, what should be given along with the application, how the application would be processed, and how the refunds would be granted. So this is, in a way, if you see the structure of this rule, it is entirely procedural, dealing with various aspects. However, when you come to sub-rule 10, there is a significant restriction which is included in this particular rule. What sub-rule 10 says? It says that a person who is claiming the refund of the IGST that he has paid on exports of goods or services should not have. And then we have two categories of notifications which are mentioned. In all, there are 5 set of notifications which are mentioned in this particular sub-rule 10. What is relevant for us in the context of foreign trade policy is the clause B of this particular sub-rule 10. It covers notification 78 by 2017 and 79 by 2017. It excludes the benefit which is availed by a person under the EPCG scheme for capital. So in a way, if a person is availing the benefit under the EPCG scheme, procuring capital goods without paying IGST, using those capital goods to make exports, to make the goods for exports and ultimately exports the goods and claims refund of IGST paid on exports, then that person would not be hit by this restriction. However, if the person claims benefit of 78 or 79 for other than capital goods, then the person gets hit by this particular restriction. So which are those benefits which are available under 78 and 79? So these are basically not the parent notifications. These are the child notifications which have been issued. The parent notification that we saw earlier in the screen are either 18 by 2015 when it comes to advance authorization, or 52 by 2003 when it comes to benefits available under the EOU scheme. So these two notifications have been amended by this notification 78 and 79 in financial year 17-18. That is, the amendment happened from on 13th October 2017, whereby over and above the exemption from duties of customs, an additional exemption is also available from IGST, which is leviable under the Customs Tariff Act when a person imports the goods under this particular notification. That is either under an advance license a person is making imports, or under as an EOU a person is making the imports. So in a way, this restriction in a way says that the moment an exporter avails the benefit under this notification, and in that situation, that exporter is barred from claiming the refund of IGST paid on exports of goods as well as services. And then the only remedy that is available for such exporters would be the claiming of the refunds of accumulated credit under Rule 89 and not under this particular Rule 96. So with this background, let me take you through the issues. So what is the first issue that is important for discussion? First is the validity of this sub-rule 10. If you find, as you saw section 16.3 of the IGST Act earlier, before the amendment, section 16.3 purely gave an option to the exporter to claim the refund either on payment of IGST or under LUT. Section 16.3 per se did not provide express restrictions allowing the government to formulate a rule to restrict an exporter from claiming the refund under one of the route, that is the with payment route. It is now that with effect from 1st October 2023, that now section 16.3 read with section 16.4 enables the government to formulate a restriction in terms of denying the person to claim the refund of IGST paid on exports. So the first question which is right now going on in the courts is this, that whether we consider this rule to be intra-virus section 16.3 of the IGST Act, or is it ultra-virus going beyond what is permissible under section 16.3. Now, to better appreciate this issue, let us also consider the purpose of bringing this restriction. Government indicated the purpose by way of circular 45 by 2019, which was issued on 30th May 2018, where the government said that, look, the purpose of this rule is to deny double benefit. On one hand, procuring inputs without paying IGST. On the other hand, exporting the finished product on payment of IGST, and therefore, in a way, using the domestic credits which are attributable to otherwise domestic supplies for making the payment of IGST on exports, and therefore encashing the domestic credit, which is to the government, which appears to the government to be not just and proper. So it is with that objective that this particular sub-rule 10 has been formulated. So when it comes to the question of testing the validity of this sub-rule, one important question that one will have to ask, that is it really a case of double benefit in all the situations? There are situations where the exporters may be importing only one of the input. The rest 9 inputs, the exporter may be purchasing either from the domestic market on payment of applicable GST, or an exporter may be importing also, but not under advance license, but as a regular imports, where the exporter would be discharging the applicable IGST. So in that situation, can we say that that exporter is still hit by Rule 96 sub-rule 10 when an exporter is able to demonstrate from the records that he has not availed any double benefit? What he has availed is otherwise legitimate credit, which is in any case attributable to exports, and therefore in that situation, the rigors of this particular sub-rule 10 should not be made applicable. In a similar dispute in the context of excise, we already have one decision of Gujarat High Court in case of Zenith Spinners, where the High Court has said that unless department is able to demonstrate the aspect of double benefit factually, the similar rule that was there in that context was held to be not applicable in that given facts. That decision has been affirmed also by the Supreme Court. So, in terms of validity, this is an issue right now that one needs to be aware of. Second is date of application of this restriction. There is a confusion. The provision that we saw is a provision which has been brought into place by notification 54 by 2018. Now, this notification is prospective in nature. This notification became applicable from 9th October 2018. Can we say that this has been the intent right from October 17, that is on 23rd October 17, when the exemptions on under the procurements done under advance authorization or by an EOU were first introduced in the context of GST by issuing notification 78 and 79. Now, if you see the the minutes of the GST Council meeting. If you see the 30th GST Council meeting minutes, the GST Council has clearly recognized the fact that prior to 9th October 18, there was genuine confusion prevailing in the trade and also in the field formations of the government, and basis which there was a lacuna in the rule, and that lacuna was corrected only prospectively by way of notification 54 by 2018. Therefore, the council in that meeting expressly said that this notification applies only from 9th October 2018. In fact, to that extent, they've issued a circular also saying that this would be applicable only on imports and exports which are undertaken on or after 9th October 18. The issue has arisen because of this decision in the case of Cosmo Films Limited, where Gujarat High Court took a view that this restriction is applicable retrospectively from 23rd October 2017. To my mind, the decision is not, with all due respect, not correct, because the decision has not actually recognized the express intent of the council, the circular issued by the board, and the express language of notification 54 by 2018, which applies only prospectively. So a division bench of Gujarat High Court has already recognized this aspect. They have, in a way, said that yes, these Cosmo Film decisions will have to be reviewed. That right now review is pending before the Chief Justice Court. So it is in that context that the issue is right now still not settled. But to my mind, given the council meeting minutes and the circular, I would say that the restriction in the context of the benefits availed under notification 78 and 79 are concerned would only be applicable from 9th October 2018. Last aspect to consider, which is again an issue going on, is let us say someone has actually violated this rule. What is the way out? One of the way out is basically to give back the refunds, but then it has a higher cost, because if you give back whatever you have received along with an interest would become a cost. Alternate is to go back to the customs, surrender your claim of exemption of only GST, the IGST that was earlier not paid. The quantum of such GST would be lower because that is the IGST applicable on inputs which have gone into making the goods on exports. The value of refund would certainly be higher because that would be applied on the sale price vis-a-vis the value of imports. So the quantum of IGST which you otherwise end up paying by surrendering the benefit on imports would be lower, significantly lower in certain situations as compared to returning the refund amount back to the government. So in that situation, you can go back, exercise that remedy, go back to the customs, recall the bill of entry, amend those bill of entry by surrendering the exemptions of GST, only GST, not duty of custom, because there is no violation as far as claim of that exemption is concerned, and then accordingly you can regularize the claim. What about interest? Interest is a contentious issue. Right now, matters are going on where the argument is like this, that look, under the Customs Tariff Act, you have created a levy by way of IGST. However, when it comes to interest provisions under the Customs Act, you are continuing to apply those provisions expressly only on the duties of customs. So unless there is a provision in the Customs Tariff Act which enables the imposition of interest on the belated payment of IGST, interest cannot be recovered in such situations. So we already had similar controversy in the context of special additional duty and CVD. Bombay High Court in the case of Mahindra and Mahindra took a view that in absence of any express provision under the Customs Tariff Act, interest is not applicable on belated payment of CVD and SAD. The matter went up to Supreme Court, and Supreme Court has dismissed the SLP which was filed by the department against the decision of the Bombay High Court. So that principle also becomes available to contest the demands, even in the context of GST, by saying that unless the Customs Tariff Act is not amended, there is no interest provision, there is no provision under the Customs Tariff Act which enables the imposition of interest on the belated payment of IGST. Now, there are also other issues related to interplay. Another issue is that, let us say, if someone makes an export without payment of IGST, that is, someone makes an export under LUT. In that situation, the person has then unutilized ITC. In that situation, how should such person claim the refunds? Because as we saw earlier, Section 54(3) clearly permits the refund of the unutilized ITC on account of zero-rated supply made without payment of GST. The question or issue which is right now ongoing is the manner in which you determine the eligible refund amount. Now, to appreciate this issue, let me take you to two sub-rules of Rule 89 that will make the matter very clear. So, one, we have this sub-rule 4, which you can see on your screen, which says that in a situation where a person makes a zero-rated supply under LUT, in that situation, the refund would be quantified by way of a formula given in this particular sub-rule, where the formula proportionately determines the ITC attributable to the zero-rated turnover. So we have a formula under sub-rule 4. Please be mark here that sub-rule 4 does not distinguish between zero-rated supply made under the scheme under foreign trade policy or a regular zero-rated supply. It applies to all kinds of zero-rated supplies. Along with sub-rule 4, we have another sub-rule 4, capital B. If you see this sub-rule 4, capital B, what it says that when a person is claiming refund of unutilized ITC, when he is making the zero-rated supply under LUT without payment of tax, and in that situation, it says that if the person has availed the benefit under notification 78 or 79, what we saw earlier, the benefits available under the exemption of GST available under the advance authorization scheme or the exemption available under the EOU scheme. In both the situations, sub-rule 4 says that refund would be available. But how much? Only in respect of inputs which have been received under the said notification, and in respect of other inputs and input services, that is ITC available in respect of other inputs and input services to the extent used in making such exports of goods shall be granted. So this is where the issue arises, that if an exporter is availing the benefit under the foreign trade policy by exercising the benefits available by claiming the GST exemptions on their imports, in that situation, that exporter should quantify the eligible claim under sub-rule 4 by adopting a general formula that we saw, or by undertaking an exercise of getting into a one-to-one correlation of what inputs or input services the person has actually used in making the concerned goods, and basis which only to that extent the person should be eligible to claim the refund. Revenue is taking a view in many matters that since there is a specific sub-rule 4, an exporter has to compulsorily claim refund only under sub-rule 4B. An exporter cannot claim refund under general sub-rule 4. My view on this issue would be like this, that look, sub-rule 4B does not start with a notwithstanding phrase. In other words, sub-rule 4B does not overrule sub-rule 4. Sub-rule 4, as we saw earlier, does not distinguish between zero-rated supply under advance authorization or regular zero-rated supply. Importantly, if you see the definition of the terms used in the formula, what is to be excluded for calculation is only when some refund is actually claimed under sub-rule 4B, or turnover in respect of the refund which is claimed under sub-rule 4B. The word claimed is very important. The claimed indicates that only if an exporter makes an actual claim under sub-rule 4B by making a correlation between his inputs, input services and exports, and basis which makes a claim of refund under sub-rule 4B. In that situation, he can again not make the claim of the relevant ITC by including the same, or the turnover by including the same in the formula given under sub-rule 4. So the government has not clearly restricted the exporters per se who are availing the benefit under the foreign trade policy to claim the refund by way of a formula under sub-rule 4. It is the interpretation which is right now canvassed in certain matters by revenue to suggest that since there is a specific sub-rule 4B, and therefore the exporter is bound to follow that sub-rule 4B and not go by the general sub-rule 4. I would say that that interpretation is not supported by the express language of the rule. That interpretation is even not supported by the scheme of the Act. The Act never entails a one-to-one correlation of particular input services with goods which are physically exported. So to my mind, certainly one can consider claiming the refund under sub-rule 4, even if someone has availed the benefits under foreign trade policy and makes an exports under LUT. Then there are certain issues which are arising because, let us say, a person is holding an advance license. Instead of making a direct input, a person issues an invalidation letter to the domestic supplier Domestic supplier bases the invalidation letter, imports certain inputs which are further used in making the intermediate product, and that intermediate product is supplied to this particular exporter. The exporter further manufactures the finished product and exports the finished product from India. I mean, that situation, as we saw earlier, under section 147, the government has notified certain transactions as deemed exports. This transaction which is happening between the intermediate manufacturer and the final manufacturer, both are in India, is considered as a deemed export by virtue of notification 48 by 2017. Now, once the transaction is considered as a deemed export, as we saw earlier, there is a mechanism available under the rule where it says that either the supplier, that is the intermediate manufacturer, or the recipient, that is the final manufacturer, can claim the refund of GST which was charged on that particular supply. Now, does that mean that in that situation, the final manufacturer can never avail of the credit, use that credit in discharging some liability, or claim the refund of whatever credit that remains accumulated by virtue of Rule 89.4, by virtue of Section 54.3, read with Rule 89.4 of CGST rule? Department has taken a view, and this is expressly coming out in the context of EOU, where the circular 172 has been issued last year, to suggest, because supplies to EOU are also considered as deemed exports. So in that circular, the board has taken a view that in that situation, compulsorily, either the supplier or the recipient should have claimed the refund under the deemed export category. This amount cannot be considered as an ITC, and therefore the refund of ITC cannot be claimed by exercising the mechanism available under the general law, that is Section 54.3, read with Rule 89.4. To my mind, the circular is contrary to the law. The law never says that it is compulsorily to claim the refund of the tax charge on deemed exports. Please remember, the tax charge on deemed exports is still a tax. It is a taxable supply. If you see Section 16.1 of the CGST Act, it says input tax credit of any tax charge on inward supply is available to the registered person. It does not differentiate between a tax which is otherwise also refundable or a tax which is non-refundable. So to our view, there is a possibility in such situations for the exporters, be it an EOU unit or a regular unit, under an advance authorization, procuring the inputs by invalidation. There is a in such situations, such exporters, to my mind, can certainly claim the refund, can claim the input tax credit of the tax charge on deemed exports, and then take recourse to the mechanism available under Section 54.3, read with Rule 89.4, to claim the refund of the accumulated credit. To my mind, the circular cannot compel such exporters to compulsorily claim the refund of the tax charge on deemed exports, and therefore deny the ITC of such tax which was paid and availed as credit. The third issue relates to merchant exporter. Again, merchant exporter can sit with unutilized credit. A merchant exporter can get the inward supply either at full rate or at a concessional rate of 0.1%. In either the situation, the merchant exporter sits with credit, which is unutilized. Certainly, the law permits the merchant exporter to claim the refund, because Section 54.3 clearly says a merchant exporter can make the exports under LUT and they can claim the refund. However, the issue arises in the quantification. Again, we have here 89.4, which is a general formula that we saw. And here we have this particular rule 89.4b clause A, which says that in a situation where where a supplier has availed the benefit of notification 40.41, that is where a supplier has charged only concessional rate of 0.1% on supplies made to such merchant exporters. In other words, he has availed the exemption from GST in excess of 0.1%. In this situation, subrule 4b clause A says that in that situation the refund would be available, but again only limited to the inputs which have actually been procured under the given notification and they have been actually used for making the exports. So again, if one goes by specific subrule 4b, it would tantamount to blocking of capital, because he may purchase now, he may export next month. In that situation, subrule 4b says you can only claim the refund when you export. Subrule 4 on the other hand considers this as part of common credit, goes into the formula. This is the formula, the eligible refund amount stands determined. Again, what we discussed earlier in the context of 4B, clause B, in the context of advance authorization, and UU, that is notification 78 and 79, would again be equally applicable. To my mind, certainly a merchant exporter will be well within the rights if the merchant exporter can claim refund also under sub-rule 4 of Rule 89 of the CGST rules. Now, there are again issues which are burning issues in the context of exports which are under inverted rate structure. So, we have certain industry which is under inverted rate structure. So, we have textile industry, we have agriculture machinery makers which are again under the inverted rate structure. So, for this industry, there is a double whammy, because if they make the exports on payment of GST, they can only pay that amount of which is on the basis of the applicable tax rate on their outward supply. So if their supply attracts 5% GST, they can only pay 5% on exports and claim the refund of that. Now, what happens to the credit which remains accumulated even after paying that 5%? Because since they are working under the inverted rate, certainly the quantum of credit on the inputs is on a much higher side than the tax that they pay on such exports at the rate of 5% or 12%, as the case may be. So in that situation, the issue that is arising is that can such person make also the claim of refund of accumulated credit on account of inverted rate structure under section 54(3) read with rule 89(5). The department, the revenue is disputing the claims. The department is relying on third proviso to section 54(3). Now, what does proviso says? Section 54(3), if I take you to those provisions, if section, that is the provisions of the CGST Act. The proviso, basically the third proviso to this particular subsection says that no refund of ITC shall be allowed if the supplier of goods or services avails drawback in respect of central tax or claims the refund of IGST paid on such supply. So the revenue says that since you have exercised the option of making the exports with payment of IGST and you have claimed the refund of that IGST, then in that situation, you cannot claim refund of any unutilized credit that remains after the said payment under subsection 3. Now, subsection 3 also includes the situation of inverted rate. So, in that situation, can this proviso be read in that manner? To my mind, certainly government should reconsider that aspect. Here, the intent of this proviso does not appear to be to deny the claim under the inverted rate category. But since it has been structured in this particular subsection in a way that it appears at the same margin level as other proviso, and therefore it in a way applies both to both the provisos, that is to zero rated supply as well as the inverted rate situation. Certainly, this is an area which government requires to consider and make it expressly clear that this third proviso would only be applicable in case of making a separate claim for zero rated supply. However, a separate claim under the inverted rate structure should still be permissible. So, this is again something that one must keep in mind. Again, here let us say such exporters who is operating under the inverted rate structure wants to make a claim of refund of unutilized credit by making the exports without payment of IGST under LUT. Again, here a person will have to make two claims. One claim on account of exports by quantifying the amount under Rule 89(4). Another claim under inverted rate by quantifying the amount under 89(5). Here again, the similar issue of what we discussed earlier is also applicable. That in such situation, if such exporter has availed the benefit of advance license, if such exporter has availed the benefit, if such exporter is an EOU unit, or if such exporter has availed the benefit of having the inward supplies at 0.1% as a merchant exporter as part of his business activity. In that situation, as we saw earlier, there is a right now issue between sub-rule 4A, 4B and 4. Again, something that one has to keep in mind. To my mind, as we already discussed, 4, 4A and 4B, to my mind, are all available to the exporter. A view compelling the exporter to take recourse to 4A and 4B does not appear to be supported by neither the intent nor the language of this particular sub-rules. Another issue that one has to consider is the amendment in Rule 89(5). The inverted rate formula, the eligible refund quantification under the inverted rate structure, the formula has undergone a change. Whether the change is a prospective or a retrospective is an issue. This only concerns the past period, that is period prior to July 22. To our mind, there is a merit in making a claim to say that even for the past period, as far as the 2-year period is not over for making the claim, one can certainly make a supplementary claim to the extent of the claim which was not made earlier for the period which is within the limitation of 2 years under section 54(1). This is the revised formula as per this particular amendment. SEZ. Now SEZ, again there is an amendment. Now there was an issue earlier that whether a person who is making a supply to an SEZ unit, whether that person has to compulsorily claim the benefits of zero rating, that is either to pay IGST and claim refund or to do it under LUT, or can such person charge the GST, collect the IGST from the SEZ unit and let the SEZ unit avail of the credit and utilize that credit or claim the refund of the accumulated credit. Is that permissible? Earlier the department had reservations, and to clear that issue, an amendment was brought into place in section 54(8). This is a provision which deals with unjust enrichment, where now, as we speak, the provision says that this is applicable only for exports. So in a way, it says that in an SEZ transaction, if the SEZ unit or a developer is going to avail of the ITC, the input tax credit of the tax which was charged by the domestic supplier, then in that situation, there is no need to claim the benefit of, compulsorily claim the benefit of zero rating. So now, to my mind, an option is available that a domestic supplier can make the exports, can make the supplies to SEZ units or developer on payment of tax. Those units can avail of the credit, and whatever balance credit that remains with them, to my mind, they can certainly also claim the refund under section 54(3), read with rule 89(4). Now, another issue that is right now ongoing is the issue of whether the benefit of zero rating is limited to only authorized operations. Prior to the amendment, which has now come into effect from 1st October 23, the law never said, the 16(1) of IGST never said that the benefit of zero rating is only limited to supplies made for authorized operations. Only when a person wants to claim a refund under Rule 89, that there was one condition to say that the refund would be available only if the supplies are for authorized operations. Now an amendment has come with effect from 1st October 23, which now says that the benefit of zero rating is available only for authorized operations. And evidence to that effect would have to be now kept by all the suppliers who are making supplies to SEZ units or developers to indicate that their supplies are for authorized operations. There is a mechanism under the SEZ rule whereby an SEZ unit which is procuring the supply will have to first intimate to the jurisdictional authority. This is that intimation, and authorization would be permitted to make the procurement. So copy of that authorization should be available with the domestic supplier so as to tomorrow justify the claim before the revenue that the transactions was for authorized operations. When this amendment came, there was a brief period where the notification permitting the claiming of refund on supplies made to SEZ units on payment of IGST was not issued. 3 days back, it has been issued. Notification 5/2003 has been issued, which permits the person, the domestic suppliers, to make the supply to an SEZ unit on payment of IGST and claim refund of that tax. Only for the restricted category of certain goods, this facility would not be available. Again, this notification has been brought into effect from 1st October 2023. So even the transactions which have happened between 1st October to 26th October, where it might happen that the domestic supplier would have charged IGST and would claim the refund of the IGST paid on supplies to SEZ units or developers. In that situation, those domestic suppliers would still be entitled to claim the refunds. Under the inverted rate, there is an issue of merchant exporter. So let us say there is a domestic supplier making a supply to merchant exporter at 0.1%, availing the benefit of notification 40 and 41, which we saw earlier. In that situation, such domestic supplier can also sit with accumulated credit. Can such supplier claim the refund of the accumulated credit? The answer would be yes. The revenue at times have been disputing that. To my mind, the rate of 0.1% on the outward side and the higher rate on the inward side of the inputs which are used clearly falls within the ambit of section 54(3) clause 2, which says that to qualify as an inverted rate, my rate of tax on inputs should be higher than the rate of tax on outward supplies. The rate of tax on outward supplies 0.1. So as long as I am having inputs which carry a rate higher than 0.1% and resulting in the accumulation of credit, then in that situation, such persons should be able to claim the refund of the accumulated credit under the inverted rate structure by taking recourse to section 54(3) clause 2, read with rule 89(5) of the CGST rules. Couple of issues more to discuss. One is regarding this realization of sale proceeds. Now, as we saw at the start of the session, if you will recollect, the definition of export of goods never mandated that the export proceeds must be realized for a transaction to qualify as exports. Unlike services, for services specifically clause 6 of section 2 of the IGST Act has that condition of realization of foreign exchange. But there is no condition in goods. However, government introduced this rule 96 capital B. This was inserted with effect from 23rd March 2020. Now, this rule in a sense says that if an exporter is not able to realize the sale proceeds in context of goods, then in that situation, within the time limit permissible under the Foreign Exchange Management Act, then in that situation, the person has to pay back the refund to the government on account of that default. Only when the RBI permits the write-off of the receivables, then only in that situation the person would not be liable to pay back the refunds. So this in a nutshell is rule 96 capital B. Now, first important question is that if on this basis, if the department or the revenue is recovering the refunds of the past period, then a serious challenge can be posed to the validity of this rule, because as we saw earlier, the definition of export of goods, neither section 16(3) as was in existence prior to 1st October 23 puts such condition. It is only now, with effect from 1st October 23, that a proviso has been put into 16(3) to the effect to say that if someone is making the zero rated supply under LUT, then that person has to realize the foreign exchange within the time limits permitted under the FEMA law, and in absence of that or on breach of that, then the person would be liable to pay back the refund along with interest. So it is only now that the parliament has categorically put this as a condition for allowing the refunds. It was never the condition prior to 1st October 2023. Now, with this, one has to also understand FEMA regulations. So, along with the presentation, I would also share the extract of the FEMA regulations. In a way, in a nutshell, one has to consider that the regulations permit a self write-off. So, in a situation where it is a normal exporter, it permits write-off to the extent of 5% of the export proceeds that the exporter has realized in the preceding financial year. So to that extent, a self write-off is permissible. You don't have to approach the RBI for getting the write-off. For a star export units, there is a higher limit of 10% which is available. So in last year, let us say a person has received 1 lakh US dollar as sale proceeds against exports, then 10% of that, so up to 10,000 US dollar, a person would be entitled for this year to undertake a write-off. This write-off happens within the ambit of law, and therefore one can say that if such write-off is undertaken, then the restrictions under Rule 96B are not breached, and therefore whatever refunds that person has claimed to the extent of the $10,000 that value of goods that he would have exported earlier would not be liable for any recovery. There is also a mechanism given under the FEMA regulations to say that if someone has a write-off beyond 10%, that is also permissible, but there is a procedure prescribed where a person has to apply to an RBI. Person has to demonstrate that he has made all reasonable efforts to realize the foreign exchange, but in absence of that realization, a person is not able to realize it, and therefore in that factual situation, the RBI can permit in those particular factual situations a write-off beyond the permissible limit of 5% or 10%. To my mind, if that is also available, then in that situation, one can say that certainly there is no breach of Rule 96 capital B, and therefore, to that extent, the person is not liable to repay the refunds which have already been granted in the past. There is also a mechanism under the FEMA regulation to seek extension of time. So the regular regulation says within 9 months of the export, the realization should come. If let us say within 9 months, if person is not able to realize the foreign exchange, then in that situation, there is a mechanism available under the FEMA regulations to seek an extension of time. Extension of granted would be of 6 months. It also has further regulation to say that in a situation where person expects even beyond 6 months that person would need to recover the foreign exchange which is unrealized, then in that situation even that is permissible. So if that is there, then to my mind, at that point in time, there will be no requirement of returning the refund back to the government. Now, issues are arising because of this amendment. Now, as you saw earlier, the amendment says that under an LUT exports, there is a condition that you should get the foreign exchange within the time permissible under the FEMA regulation, which would also certainly include the extension which you may seek. But what happens in a situation where you are not able to realize that? Currently, Rule 96B takes care of that situation, where it says that if write-off is permitted, then in that situation, you are not liable to repay return the refund back to the government. But now the amended section 16(3) proviso does not take care of that eventuality. That in a situation where write-off is permitted, in that situation, you are not obligated to return the refunds that have already been sanctioned. To my mind, Rule 96B still remains on the as part of the CGST rules. Proviso to 16(3), the amended 16(3) also says that that restriction is still subject to further restrictions which would be prescribed. So then an harmonious interpretation if one makes of the amended 16(3) proviso with Rule 96 capital B, one can take a view that in a situation when the government is actually permitting write-offs and not recovering the GST basis those write-offs, in that situation, then the exporter is not liable to repay the refunds which have already been sanctioned, subject to the fact that he is having a documentation to demonstrate that the write-off is either a self write-off within the permissible limit of 10% or an exceptional write-off granted by the RBI. This is the application filed by that particular exporter. Now, we have situations where there may be change in the export value. There may be a reduction in the value. A person may issue an invoice of, let us say, 1 lakh euros. And then the customer may demand a reduction in value for numerous reasons. In that situation, how do you consider the issue pertaining to refunds? Because a person has already claimed the refund of IGST paid on that 1 lakh euro. Or a person would have considered that 1 lakh euro as a value of zero rated supply for determining the eligible refund amount if such supplies are made under LUT when it comes to quantification under Rule 89(4). See, here also again the law is silent. The law does not really provide for how do you handle this situation. Section 34 of the CGST Act talks about credit notes, debit notes. But to my mind, that does not apply to zero rated transactions because those applies only to a taxable transactions. These are transactions which are different specie by itself, where the transactions are not made liable to tax. And on the other hand, the refund of input tax credit is permissible. Now, here to my mind, one will have to read the FEMA regulations into Section 16 of the IGST Act and then look at the purpose of Section 16. The purpose of Section 16 is to refund whatever credit has accumulated on account of exports. The value is only a denominator used for the quantification of the refund amount. FEMA regulation, what we saw earlier, permits the exporter to reduce the value. There are conditions stipulated in the FEMA regulation which says that the reduction is permitted only to the extent of 25% of the invoice value. Beyond 25% reduction is not permissible. So if let us say 1 lakh euro invoice you have issued, only reduction up to 25,000 euros would be permissible under the FEMA regulation. So to my mind, if those regulations are adhered and basis which a reduction has happened, then to my mind, there is no breach in the provisions of the law. Therefore, in our view, the exporter would not be made liable for return of the refunds which have already been sanctioned based on the original invoice value of 1 lakh euros. Again, see something that government should certainly clarify. Otherwise, this issue can lead to disputes, unnecessary disputes, without any gain. Because in any case, the intent is to ultimately give the refunds vis-a-vis the exports which are happening from this country. Last issue that I wanted to discuss before I end is regarding this compensation cess. Now, as you are aware, compensation cess is leviable on only certain specified goods. So take a situation where an exporter is using coal in his captive power plant for generating power, which is ultimately used for manufacturing goods which are exported. Now, on purchase of coal or on the import of coal, there is a levy of cess, which is the compensation cess under the GST Compensation to States Act, where there is an ad valorem levy of 400 rupees a ton. So, a person has purchased the coal by paying the applicable cess. Now, a person has manufactured the goods, let us say paper products. Those products do not attract cess on the outward side. Or let us say he is manufacturing chemicals, exporting chemicals. Chemicals does not attract the cess on outward side. So if that person chooses to export the goods on payment of IGST, only to the extent of IGST that person can pay and claim the refund of whatever accumulated GST credit which has happened. The person cannot pay cess and claim the refund of cess credit which has been accumulated. However, if a person exports the goods under LUT without IGST, then a person is entitled to claim refund of both the accumulated credit of GST as well as the accumulated credit of cess to the extent of exports. That law is settled. Now, where the dispute is this circular. Circular takes a view that only under LUT, if you are doing exports under LUT, we will give the refund of cess. If you do exports under with payment of IGST, then in that situation, since you have not paid cess on that product, we will not give the refund of cess. To my mind, this circular certainly conflicts with section 11 of the GST Compensation to State Act. If you see section 11 of this particular law, it says that all the provisions of the CGST Act, IGST Act are to be applied to the cess law, mutatis mutandis. Now, what does this phrase mutatis mutandis mean? Mutatis mutandis means that wherever the word GST or tax has been used in the CGST Act or IGST Act, that has to be replaced by the word cess. So now when we borrow section 16 of the IGST Act and apply this in the context of this law, one will find that on my chemical exports, even though I have paid GST and not cess, for the purpose of cess, it is still an export under LUT without payment of cess, because cess is not leviable on that product. So one has to distinguish, because these are two separate levies, GST and cess. So a transaction done under GST law on payment of GST cannot automatically imply that that transaction also under the cess law would be under the with payment route only. And since cess has not been paid, refund would be denied. To my mind, when it comes to the cess law, one has to read the transaction as if it has been done without payment of cess. And therefore, even in such situation, the refund should be available. There cannot be a discrimination in a sense to say that if you do exports under LUT and claim refund of GST, of the accumulated credit of GST, only in that situation we will also give the refund of accumulated credit of cess. If you do transactions on payment of IGST, then only to the extent of GST we will give the refund, but we will not give the refund of cess. To my mind, again, this para 5 of this circular, which takes this view of giving refund in one situation and denying it in other situation, appears to be in total conflict with section 11 of the Compensation to State Act, and therefore to that extent already the disputes are pending in the courts, where the validity of this para 5 itself has been challenged by the exporters. Last, that is samples to customers, stock transfer to branches, and supply to agents. Now, what is the issue involved in all these three transactions? All these three transactions have a common theme. What is the common theme? There is no consideration, because there is no property is not passing to a third person against a consideration. Samples are given without consideration. Stock transfer to my overseas branches also does not have consideration, because it is same legal entity which has a branch there. Supply to overseas agents, again not a sale, no consideration. So in all these three transactions, there is no consideration. Can still this transaction be considered as a zero rated supply, and therefore the credit of the input services attributable to such supply would still be available and refund would be available? Issue is highly debatable. Why I am saying that? In case of sample, to my mind, it is not a supply because it is given voluntarily without consideration. The supply under section 7(1) requires a consideration. Only in a case where a transaction is covered under schedule 1, that a supply without that transaction without consideration can also be considered as a supply. So to my mind, since samples do not have consideration, it is not a supply. Zero rated supply, although includes exports, definition of exports says taking goods out of India to a place outside India. That would not imply that just a physical activity of taking goods out of India would qualify it as a zero rated supply, because zero rated supply requires satisfaction of two conditions: export, and it should be a supply also. So in absence of supply, to my mind, if the samples are given to overseas customers, it is not a supply. Therefore, it cannot be a zero rated supply. Therefore, it has to happen on a delivery challan. It cannot happen on an invoice, and therefore no refund of accumulated credit vis-a-vis these transactions would be admissible. There can be also implications on the ITC front, where under 17(5)(h) it says that ITC in respect of free samples is restricted. So to that extent, even section 17(5) would apply, and therefore, as we saw under section 16(2) of the IGST Act, even if you are making a zero rated supply, still provisions of section 17(5) would still be applicable. So to my mind, ITC would get restricted, and also no further refund would be eligible in case of samples. In case of stock transfer to branches, the issue is highly contentious. Why? Because if you see schedule 1 says supplies between distinct person is considered as a supply, which is even without consideration is considered as a supply. For a transaction to be zero rated supply, it has to be a supply. Therefore, one has to understand whether sending goods to a branch outside India, whether it qualifies as a supply. If you see the concept of distinct person from perspective of section 25(4) of the CGST Act, it only includes those persons, those branches which are having separate GST registrations or which are required to have separate GST registrations. Foreign branches are not specifically covered under section 25(4). However, if you go to the IGST Act, if you see section 8 of the IGST Act, and if you see the explanation to that section, it says that a person who is having establishments, one in India and one outside India, then those establishments of that same legal person would be considered as distinct establishments. So to my mind, one has to apply that concept in the context of Schedule 1, serial entry number 2. Therefore, one can consider taking a view that sending the goods to the branches outside India would also qualify as a supply by virtue of Schedule 1, and therefore, to that extent, the refund of the credit, accumulated credit vis-a-vis the zero rated supply would be admissible. Similar propositions also is applicable in the context of agents, where entry number 3 of Schedule 1 clearly covers a transaction between a principal and agent as a supply when the agent is going to make a further supply of the given goods. So again, to my mind, in this situation, I would say that giving the goods to a foreign agent would qualify as a supply, even if consideration is not there by virtue of Schedule 1 entry 3, and therefore basis which a view can be taken that refund of accumulated credit would be available. So this, friends, in a way captures all major burning issues which are there in the context of exports, both of goods or services. I again thank the Taxmann for allowing me this opportunity. Although the time is short, the idea of this session was to sensitize the trade, sensitize the industry, sensitize the revenue, sensitize the government that these are the issues that have to be looked into. These are the issues where favorable clarifications should be given, because ultimately we are talking about exports. We are trying to make India an export hub. We are trying to make India a manufacturing hub for exports. So in that situation, I would say that on all those issues, if clarifications come sooner, it would certainly be a big aid to the taxpayers. So let me see if there are any questions. There are a couple of questions. Let me just, if the organizers feel okay, I can take a couple of questions. So first question deals with 9610. 9610, I have already explained at length that let us say a local supplier has taken the exemption, but when that local supplier has made the supply to me, if he has charged full GST, then in that situation, I would take a view that I would not be hit by restrictions under Rule 9610. As far as EOU is concerned, see, in case of an EOU, as I said, the supply to an EOU are considered as deemed exports. So there is an optionality available in law where either the supplier or the recipient can claim the refund as a deemed export by following the procedure given in circular number 14. There is a mechanism given by way of giving form A, filing form A, and basis which the claims can be made, or alternate, EOU unit can avail of the credit of the tax charge on such supplies and ultimately claim the refund of the accumulated credit under general provisions of section 54(3), read with rule 89(4). Now, there is third question. There is a notice issued. The party is not able to reply to the notice and therefore the refund has been rejected. See, in such situation, it's a technical issue. It appears to be that on technical glitch by which the party could not respond and ultimately the adverse order has been passed. One can consider taking this matter straight away under writ jurisdiction by seeking a direction from the Honorable High Court to allow the fresh adjudication of the given notice, given the fact that natural justice was denied because hearing was not given and the exporter was not in a position to even file the reply against the given show cause notice. Rule 4243 applicable in case of export of goods? No. See, Rule 4243 is applicable only in case of exempt supply which are domestic supplies in nature. Rule 4243 does not apply because, as you already saw, Section 16 subsection 2 of the IGST categorically says that in case of exports, barring 17.5, no other restrictions are applicable. So 17.2, basis which Rule 4243 have been formulated, would not apply to exports or to rather zero rated supplies. And therefore, to my mind, there are no other restrictions or blockages in claiming the credits vis-a-vis the exports concerned. In case of deemed exports, it is not possible to claim refund of IGST. Yes, this is again a very practical issue. See, in case of deemed export, what happens? The mechanism is like this, that even if you want to claim the refund of the tax charge on invoice, you will have to first take it in your credit ledger and then debit from your ledger. Now, before you debit, when you file the return, let us say there is another other liability which is there, and for the payment of that liability, you exhaust the IGST which is available. So, under the deemed export, the supplier would have charged IGST. But when you want to make a claim of the tax charge on that invoice, there is no IGST balance available in your credit ledger. And therefore, in that situation, issue arises as to how do you file the claim. It's a very genuine issue. We are also dealing with such issues where basically we are taking a view that, look, the order in which the ITC is to be utilized is formulated by the parliament, and government has notified the restrictions how that utilization has to happen. On the other hand, there is a right of refund also created by the parliament. So in that situation, the right of refund should prevail, and therefore in that situation, I should be able to claim the refund of the GST that is charged on the deemed exports. So a manual application under any other category can be filed, and basis which one can pursue the claim.